Hello everybody, Jackson here from the Wealth Squad today, talking about how to screen for dividend stocks, what to look for. Specifically, we're going to be using finviz.com. They have a great screener, which is basically this thing right here, right? We're going to go through and swift through a whole bunch of criteria for different stocks, see which ones we want to, consider, and dump the ones we don't. So we're going to go through and put some important dividend and company metrics and see what we find at the end, what companies we should look at more into. So right away, I like to start off with country, USA, and market cap above 2 billion. That just makes things easy. And then I like to go to a dividend, of course, of 2%, which is kind of conservative, right? If you want more, obviously go for more, but we're just going to do 2% here because we want a solid underlying company as well, right? We don't want a slow business that pays 6% a year that loses, right? That just doesn't go with the market. We want something that's growing. So besides that, payout ratio under 70. So what I like to look for is 75, but there's no 75, so 70's you'd rather be safe than sorry, so that's why I don't put 80. And then the forward PE under 30, which is just the forward earnings. Quick ratio under 1, over 1 actually, not under 1. That just makes sure that the company has enough cash to continue to operate. Then we have debt to equity under 1 as well, which is also conservative. Usually you could go even more than that, but just for this video, we're going to be looking at just the 43 entries here with this criteria. And right away, you could look from valuation and see which companies are like the cheapest based on the 4PE. So we actually are screening, we're sorting by market cap, right? So we have Johnson & Johnson, Pfizer, Costco, Intel, Texas Instruments, ConocoPhillips, APD Chemicals, or Air Products and Chemicals. So Emerson Electric, General Dynamics, stuff that you have heard of. And you can see their PE. PE doesn't really matter. It's just the earnings right now. 4PE is, I think, the more accurate, which is earnings next year, right? What are they planning to be? PEG is also pretty important. So let's just do, let's cut this, right? Under 3. 3 at anyways, right? It's still pretty high. But just for this, we're going to be looking at, now let's cut it. We'll do under 2. There we go. Right around 20 is what we want. All right. So now that we have these companies at our fingertips, you want to look through them, just see what you know. Pfizer, we looked through a couple of these. Dow, Archer Daniels, Minden, Cummins, International Paper, Tapestry, Packaging Corporation of America, Snap-on, Ralph Lauren, H&R Block. Some stuff you've heard of, some stuff you haven't. But anyways, regardless of if you have heard of them or not, you want to look into these companies because they're your final product, right? Right away, I could see Dow is pretty cheap, just based on nothing more than the numbers right here. Huntsman is pretty cheap. So chemicals are pretty cheap, right? They both produce chemicals. Maybe that's not a business you want to get into, so you want to avoid those, right? Snap-on, tools, of course. They do stuff for cars, and tools in general. Archer Daniels, Minden, farm products. So you can see just based on the PE, 4PE, and PEG, the stuff below 1 is the more preferred. But even 1.59, and it doesn't turn red, right? If it's red, that means it's, not a good number. It's higher than it should be. We talked about PEG on the earlier video, on one of the earlier videos, but let's look at actual performance. See if we could get these at a discount. No, even better is technical. No charts. That's what I'm looking at. So we can see this is the year chart. Or seems to be longer than a year because that's March, or less than a year, right? So we're looking for stuff trading at a discount. So Cummins pretty cheap, right? Packaging Corporation of America pretty cheap. range from 155 to 130. Snap-on, Chain at a discount, Ralph Lauren, Huntsman. Keep going. Manpower. So you can see the stuff trading at a discount. We're just going to look at these over here. Pfizer obviously not. Goodyear somewhat. Dow definitely. International Paper definitely. Cummins definitely. Not really. Not really. Yeah. Not really. Not really. Not really. And somewhat. And based on these companies, you want to look into those specific ones, right? So, Cummins looks pretty interesting at this price. We could see it's trading at the same price it opened at on this chart, on the daily chart. And you can see some pretty solid numbers, right? Nothing too green nor red. However, just some earnings falling and, of course, below some moving averages. But that's all technical stuff that doesn't have to do with anything based on the actual company. And we can see the range, so it's 5% above the 52-week low, which is 220, 17% below the 52-week high. So it's not a huge mover, right? Went from 220 to 270 within the year, just ranging. But you can see some downgrades, upgrades, some recent news, and of course what they do at the bottom here, as well as some earnings and financial numbers. But you got to look more into it based on just more than the FinViz site for that company, right? You want to look more into the company, read their actual earnings reports, see what the CEO says about the latest quarter, latest year, that type of stuff. So let's go back to overview. We produced 19 quality companies just based on using 1, 2, 3, 4, 5, 6, 7, 8 criteria, screening for dividend stocks. If we want to do more, do over 3, and it obviously cuts down. But now you have companies paying over 3% instead of just 2. However, with a small dividend is more potential for growth. That's what a lot of people don't understand. Apple has less than 1% dividend, but it's growing like no other. Same with Microsoft and Visa. Those companies, they pay a small dividend, and many dividend investors would pass up because it doesn't cover their cash flow. If you're investing just for cash flow, then stuff like AT&T, for example, would pass your test, 8.5%. However, if you look at the PE, the PEG, their debt is out of control. They don't have enough cash to satisfy their expenses. You see the chart on a huge downward trend, just nonstop. But if you're just going for the cash flow, right, then you go for that 8.5%, not knowing the stock could fall, obviously more than that. So you always want to look further into the company rather than just the yield. That's what I'm trying to get at here. What you're buying is not a dividend paying asset. You're actually buying a legit company, and so you want to look into what that company does, how it makes money, if it's doing a good job at doing that or not, before you look into what type of dividend they pay, if anything, how much. So I hope that makes sense. I hope you enjoyed this video, learned something about screening for dividend stocks using finviz.com. If you did, please press the like button and subscribe for more videos every Monday, Wednesday, Friday. Thanks.